What's up, ladies and gentlemen? Welcome back to Chickenomics. Today we're going to talk about 6 types of investing you can do within the stock market. I'm going to throw these up, show them what's going on. I'll leave a link to this article down in the description. But before we get started, go ahead and hit that like button, hit that subscribe button. It's really a way to support the channel and me for free. I'm also going to put in the description my new Clarity profile. If you ever want to schedule a one-on-one with me, you'll be able to do it through there. Link will be down in the description. And as always, if you want to get started trading some stocks, or most of these things we're about to talk about actually, you can do all of that through Robinhood. I'll have my link for that down in the description. If you sign up through my link, you'll get a free stock. I'll get a free stock. Another great way to support the channel for free. Anyway, let's get into it. First thing, stocks. This is what everybody hears about when they hear about, well, we're going to invest, we're going to do that, we're going to do this, we're going to do the other. Well, what buying a stock is for is to own part of the company. You own part of the company, you get some of the earnings and assets, and you just earn whatever percentage of that company equates to one stock. This is typically good for short term and long term investing, depending on the kind of stocks you're buying. If you buy a dividend stock, that's more for building long-term wealth, which we'll talk about in another video sometime this week. And if you're buying something that has a lot of volatility, that's more for trying to buy and sell to make a little bit of a profit that way. When you're buying stocks, you are basically getting started and getting your feet wet and learning a little more about it. When you're buying bonds, this is basically, depending on who you buy a bond from, a little bit of guaranteed income, but they're pretty low. What a bond is you're loaning a company, the government, some other entity, some amount of money with a guaranteed return. So I'm going to loan them $100, and they're going to pay me back $102 in this many months or a year or whatever. Bonds always have a maturity date. What that means is if you buy a bond on X date, you'll get X amount of dollars. And that's kind of how some people use them. I would advise always having bonds in your portfolio. That way, it's kind of a little bit of an almost guaranteed income. Mutual funds. So, mutual funds are, they're not my favorite. Um, Mutual funds, you purchase a large number in a single transaction, right? They pull a lot of money together from all the other investors, and then somebody handles the fund. So the return on these is a little lower because mutual funds pay someone to invest the money back into other assets. They follow a strategy, and they are a really good long-term option because they have slow, steady growth, and they pay dividends, but they usually pay a small percentage. Um, these are pretty much good on just the wealth side. I wouldn't be trading in mutual funds for income. Um, Talked about the difference between income and wealth in another video if you want to check that out. Index funds are great for any kind of investing. So if you get into index funds, so an index is a type of mutual fund, but it tracks an index. So what an index is a group of assets. So the S&P 500 will be, well, here's a really good way to explain it. An index fund is a type of mutual fund that passively tracks an index rather than paying a manager to pick or choose investments. So you're not paying the manager to trade the 500 different assets in the S&P 500. You're just buying a share of the S&P 500, and you get it's basically like having fractional shares of all of the stocks that are inside the S&P 500. Um, they cost a little less because they don't have a manager. The risk is a little lower because you're diversified across um, a bunch of different assets. Uh, they earn dividends. So index funds are again really slow on the income side, but are more for the wealth side. When you're building your portfolio, index funds are good to have when you have X amount of money that you want to make a steady return on at a lower percentage. Exchange traded funds, so ETFs, it's a type of index. They try to mirror the index's performance success right there. They're a little cheaper because they're not actively managed. Um, so these aren't really the best for beginners either. Um, I don't really know a lot about this one, so I'm going to skip over this one to be honest. Options are another really, really, really good way to make income if you understand how they work. So, options have a definitive date that they end. Whether you buy or sell an option determines whether you make money from the purchase or the sale of the stocks. So, it's a contract to buy 100 shares of an asset. Um, I'll go into a little more depth with this one, but this one, since it's so short term, is good for income if you understand how they work, but not so much for wealth because you can't really build off of something that has a definitive end date. Um, if you are going to trade options, I'll put out a video about that. That's a really touchy subject because if you go about it the wrong way, trading options is on the verge of gambling, and that's not exactly a really healthy way to invest your money. Um, when you go down through here, this is the last one, number 6. Um, when you're buying an option, if you buy a call, that means at the end of that option's lifetime, you want to call to you the the asset. So if you buy a call and it expires, and you're within the range of money that it expires in, you get to buy 100 shares of that asset at X amount of dollars, whatever that the option ended at. And the same thing for a put, which is the other side. If you put, that means you get to get rid of the asset for that amount of money. So, like, say if you have an option to sell 100 at $7 a share, when it goes down to $4 a share, if your put expires while it's at $4 a share, you get to sell 100 of yours at $7 a share, while everybody else who's trading in normally gets to sell theirs at $4 a share. So they're good for some things, bad for others. We'll have a video going over all of that. Um, like I said in the beginning, I'll have a link to this website so you can check this out and read all of these. Um, if you have any questions or comments, leave them down the bottom. We'll look into that. If you have any requests for any other videos or any information, just let me know. Uh, check out my Clarity profile. We can schedule a one-on-one and see what your goals are and go from there. Anyways, I'll catch you guys in the next one. Happy trading.